RBA has lifted the official cash rate again, and this isn't just a number. The Reserve Bank of Australia raised the cash rate to 3.85% in Feb 2026, pushing the mortgage cost higher for many Australians. Banks are already passing this on, meaning higher repayments for a lot of borrowers. Mortgage brokers on the ground are also saying that this rate environment is not necessarily over yet, and future increases cannot be ruled out unless inflation eases meaningfully. So, what's the 3.85% RBA cash rate really means? The cash rate is the base cost of money for the banks. When it rises, the bank's funding cost increases. The variable mortgage rates usually rise. The borrowing power for the new buyers reduces, and existing borrowers feel pressure on cash flow. So the real impact is not just today's rate. It's about how well your loan handles the change. So the big question, should you refinance? The honest answer is not automatically. Refinancing may make sense if your current rate is clearly uncompetitive, if you're not locked into heavy break cost, if the cash flow is under pressure, and if a new loan structure would genuinely improve flexibility or repayments. Refinancing is one option, but not always the right one. What matters most in this environment is to know how your loan is structured and how your cash flow is managed. In many cases, reviewing or adjusting an existing loan can be just as effective without taking on unnecessary risk. In a higher or uncertain rate environment, three things matter more than most people realize. The first is the loan structure. We all know the loan structure includes things like variable versus fixed loans, whether you have an offset account, how easily you can make extra repayments, whether redraw is available, and how the loan is divided. That is one loan versus multiple splits. Not all loans behave the same way when the rates move, and how a loan is structured can make a big difference to how manageable repayments feel over time. The second is buffers. Buffers are not about having extra money. A buffer is usually your ability to handle the change without panic. A borrower with buffers thinks that I'm okay if rates move again. And a borrower without buffers thinks that I hope rates don't move again. Now that difference is everything. This includes money sitting in an offset account, extra repayments already made, surplus cash flow each month, and access to withdraw wherever appropriate. The third is repayment comforts. Repayment comfort is not about, can I afford this right now? It is usually about, can I afford this if the rates rise again? Can I still save something each month? Can I absorb unexpected cost without stress? Or does this loan limit my life decisions? Now that gap is where either confidence or problems show up. So, what can borrowers actually do now? Here are some practical steps. First, ask yourself, if the rates rose again, would repayments still feel manageable? Could you still save something each month? Or would a surprise expense create stress? If repayments already feel tight, that's a signal to review the structure and cash flow. Second, Understand how flexible your loan really is. It's worth knowing, do you have an offset account? Can you make extra repayments without penalties? Can you redraw if needed? Is your loan fixed, variable, or split? Flexibility matters more in uncertain rate environment. Third, build buffers wherever possible. Buffers don't need to be perfect or large. Even small buffers reduce pressure when the rates move. It gives you options and help avoid emotional decisions. Now the goal is not about perfection, it's a breathing room. Fourth, avoid reacting only to headlines. Rate headlines are designed to grab the attention, not to guide the decisions. So before reacting, step back from the number. Understand your own position and focus on what you can control. You don't need to change something immediately. And lastly, recheck numbers before committing. If you're planning to buy, you need to know that the borrowing power may be different from earlier in the year. The repayment comfort matters more than the maximum approval. Updated numbers lead to better decisions. So, what do we take from all this? Rates will keep moving, but good planning and the right structure helps you move with them. Remember, clarity upfront helps reduce pressure later.